Hi, and welcome to the Michael Yardney podcast. Now, hindsight's a wonderful thing, isn't it? But let me ask you a question. Knowing what you know now, what would you have done differently if you had the opportunity to invest in property 10 years ago? What about 20 years ago? Or even 40 years ago? Now, I know some of you are thinking, hey, I wasn't even born 40 years ago. Well, I've been investing for over 5 decades, which gives me the perspective to see patterns in the chaos that many others see in the world of property and the economy at the moment. So in today's episode of the Michael Yardney podcast, I want to take you back to 1980, just over 40 years ago, which was an interesting time. It was a challenging time in the property market in our economy, but in fact, it's a time that was reminiscent to the current economic situation. And then, as we chat, I want to share with you 40 property investment lessons I learned over the last 40 years. Now, I know about a month or so ago, if you're a regular listener, you'd know that I had a show about 23 lessons I learned from 2023. Hey, but don't worry, this is a very different show because I want to share some other lessons with you that I hope are going to give you some directions and some certainties to navigate the challenging property markets ahead. Oh, by the way, if you hadn't heard that other episode about the 23 lessons from 2023, which was a great year for many people in property, if you hadn't heard that particular episode, go back on whichever podcast player you're listening to this to the beginning of February. Not now, but have a listen to that show because you're going to learn some other insights. By the way, regular listeners would know I usually have guests on the Michael Yardney podcast. However, today it's going to be a chat, just you and me, as I share 40 property investment lessons I learned in 40 years. So, welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Let me ask you a question. With the benefit of hindsight and knowing what you know now, if you had the opportunity to do so, would you have bought an investment property 40 years ago? Now, play along with me, even if you weren't in the position to do it 40 years ago or you weren't even born then. I guess if you could go back in a time machine, I bet your answer would be yes, realising that at the time, the median price of properties in Sydney was around $68,500 then, and you could have bought a median price property in Melbourne for just $40,000. By the way, I did. Now, let me ask you another question. What if you didn't have the benefit of hindsight and we were both back there then, you and me, in 1980, which was, I guess, 43 years ago, and just as you were about to invest in that property, the one I told you that you were going to buy because, boy, you've seen how it's gone up, what if I told you that in the next year or two, Australia would fall into a recession? And what if I told you that in 6 years' time, the government of the day, the Labor government, would remove negative gearing? Of course, they'd introduce it a couple of years later. What if I told you there was going to be a stock market crash in 1987, a worldwide one, which caused a severe recession in Australia in 1990s? Boy, that's when interest rates went up really high. Do you remember? Or you've probably heard about those times. Anyway, having put all that together, it meant that the first decade of owning your investment property, you'd have had to face all those headwinds. So knowing that, would you have still bought that property back in 1980? Of course, with the benefit of my time machine, and you could still be back there, you and I'd be back in the 80s as you plan to buy that first property, I'd also warn you that there'd be an upcoming AIDS scare. We were worried that this was going to be a worldwide pandemic, and that there'd also be a SARS pandemic. And then there'd be an Asian financial crisis. Then on September 11th, some planes would fly into the Twin Towers in New York, creating havoc. Or what if I told you there was going to be a global financial crisis in 2008 that would affect stock markets and property markets and economies around the world? Oh, I would have also probably warned you there'd be a coronavirus-induced, almost recession and challenges in the 2020s. Hey, would you still have had the courage to buy a property way back then in 1980? Now, the answer for many people would now be no. Why on earth would I invest in property knowing that there are going to be so many challenges, so many problems, so many risks ahead? And of course, they would have missed out on some amazing wealth building opportunities, wouldn't they? How do I know this? Well, I was already investing for about a decade back in 1980. And yes, I did buy another investment property that year. And over the years, the capital growth I achieved from my investment properties allowed me to keep adding to my portfolio, meaning that today I've got a significant, substantial cash machine that gives me the lifestyle choices I was looking for back then. Of course, along the way, I had some great investment wins, but boy did I have more than my share of mistakes and got things wrong and things I do differently today. I learned many lessons that I wish I knew back then, but there wasn't podcasts, there wasn't YouTube, there wasn't Facebook, there weren't blogs. I started blogging or writing, it wasn't even called blogging in the early 2000s. So I had to learn the hard way. But I'd like to share with you 40 property investment lessons I learned in the last 43 years so that you don't have to learn the hard way like I did. The first lesson I'd like to share with you is that the economy and our property markets move in cycles. Now, I knew nothing about that when I first invested. I bought my first investment property in Larch Street, South Caulfield for $18,000. I went halves with my parents because I couldn't afford more than $1,000 deposit. They put $1,000 down, and we took a $16,000 loan for 30 years. We had no idea how we were going to pay it off. Oh, by the way, we got $12 a week rent, and we were excited. But I didn't know about the ups and downs and the booms and busts. But I learned. Boy, did I learn about property cycles. I learned that booms never last forever, because I was carried away with the boom initially. I thought, this is great. I also learned that neither do busts last forever. And booms and busts are occurring because we're swept up in optimism or the pessimism of others as well. So I learned not to be surprised when they come around, but I also learned not to overreact, because this will help you avoid being sucked into the booms and spat out during the busts. And despite the ups and downs of the property cycle in all those years, over 5 decades I've been investing, the long-term trend for well-located capital city properties is that they go up. Yes, they don't go up every year. They remain flat for some years, and they definitely go down over time. But this long-term growth of property values is underpinned by Australia's population growth and our demographic changes, as well as the underlying wealth of our nation. And that's allowing us to afford more expensive properties. So if you believe that Australia's population is going to keep growing, and we know the Australian government's got a business plan to grow our population significantly, to grow to over 40 million people by the middle of this century. And if you believe we're a knowledge-based society that's going to become wealthier, the same is going to continue on. The wealth of the nation and the size of the nation is going to underpin our property markets, because in general, we all want to live in the same 5-6 capital cities and in the same locations in those cities as well. Now, another lesson I learned, and it took a while because there wasn't a lot of information about property in the early days, but I did learn along the way that even though they're armed with all the research, especially in today's information age, economists never seem to agree where our property markets are heading, and they usually get their forecasts wrong. Now, that's become very clear over the last couple of years, hasn't it? You see, market movements are far from an exact science. It's much more than just the fundamentals, which is relatively easy for the economists to work out in their offices. It's much more than fundamentals that move markets. One of the overriding factors that the experts just can't quantify is consumer sentiment, buyer sentiment, investment sentiment. That's one of the things they missed out on over the last year or two, where despite rising interest rates, there were just so many of us wanting to buy. Now, over the years, another lesson I learned was that every year we get hit by an X factor, an unforeseen event or situation, something that blows away all our carefully laid plans. Now, sometimes they're for the positive. If you go back a few years, in 2019 there was an unwinnable election. The Labor government lost and the Liberal government won because the Labor government had some ideas at the time of changing capital gains tax and a few other tax things. So you may remember that the property market was in a slump because people were concerned about that, but then all of a sudden, out of the blue, something positive happened. Sometimes they're negative effects like overseas problems or COVID. But I guess the point I'm making is be prepared for your plans not to go to plan, because we get hit by an X factor or a number of them every year. So risk isn't all those things you've looked after and thought about. It's the things that come to you that you hadn't thought about. But the other big thing I learned was every decade or so, we have a major event and the world breaks. That's bigger than those little X factors. Well, the X factors aren't always little, but the world breaks. COVID, the global financial crisis, things like that September 11th that really messed things up. The other lesson I learned, and it took time as I started to research the markets, but I learned many years ago, was that there isn't an Australian property market like the media talks about. There are multiple property markets. So each capital city has within it multiple markets divided by geography, by price point, the type of property. So apartments perform differently to houses, new home areas for houses, suburbs perform differently to gentrifying suburbs. So when somebody tells you the Australian property market's doing this or the Sydney property market's doing that, don't pay any attention to them, because this type of information is really of no use to you. You need to examine what's happening to property markets on a much more granular level. I keep talking about these lessons. I hope they're helping you. There's another one I'd like to share with you. The property investment's risky in the short term, but it's secure in the long term. And property investment's definitely not a way of getting rich quickly. Risky in the short term because there are ups and downs and periods when the property market's flat. But as I explained, go back 10, 20, 30 years and you can see, boy, how property markets have grown, values have grown. Well, not all properties, well-located properties. And I've found it takes the average property investor around 30 years to become financially independent. Now you're going to say to me, Michael, I haven't got 30 years. Well, let me explain. Often the first 10 years are wasted making mistakes and learning what not to do, following the wrong path, taking the wrong strategy or not having any strategy. And then as an investor, you've got to change that, sometimes get rid of underperforming properties, and then invest through a number of property cycles to grow a substantial asset base. And because property investment's a long-term game, don't look for what works now. Instead, look for what has always worked. But the media is going to tell you about what works now, the top 20 hotspots for this year, or which suburbs are going to outperform in the short term. It doesn't work that way, because what you really need to look at is what's worked always, not just works now. History has shown that this year's hotspot becomes next year's not spot. So don't make 30-year investment decisions based on the last 30 minutes of news. Now, as I started learning about property years ago, as I was starting to say, there weren't many books or blogs, but there were American books that I read and I learned from, and they didn't really apply to Australian residential real estate because the rules are different here, the tax rules are different here, the psyche is different here. And so a lot of them talked about cash flow. And then people came from overseas, including Robert Kiyosaki and Dolph DeRoos and a whole lot of other names I can think of that came and sold their seminars and told you to invest for cash flow. But residential real estate in Australia is a high growth, relatively low yield, relatively low cash flow investment class. And I learned that wealth is created by building a substantial asset base. You do this by holding good investments for a reasonably long time, then reinvesting the income you're receiving and allowing your capital gains to build up, and then you take advantage of the magic of compounding and leverage. Now, that's not how most people invest. A lot of people want to invest for cash flow because they haven't got money. But if they can't control their money in the first place, investing and taking on leverage and debt isn't the right thing anyway. So residential real estate is a high growth, relatively low yield investment, and don't try and change it. It doesn't work. Now, another lesson I learned, and I learned this quite early in the piece, was that at times of poor or no capital growth, strategic property investors manufacture capital growth through renovations and development. I started doing some renovations in the late 1970s. I got involved in property development in the 80s. I did some very big, brave developments in the 80s. I was carried away by a very substantial property boom. boy, did I make a lot of mistakes, but the boom covered it up. If I made those mistakes today, I'd go broke very, very quickly. But what I learned was that strategic investors manufacture capital growth through property renovations and development. And that's still how I invest. And our more high net worth clients at Metropole do as well. Now, you don't have to be a high net worth client to use this strategy, buying the worst house in the best street and then one day pulling it down and putting 2 townhouses is the strategy a lot of our higher net worth clients do. And we're actually involved in, I think it's about 65 developments at the moment in Melbourne and Brisbane for clients, and that's what I've been doing, building townhouses and keeping them, not selling them. But if you haven't got the funds for that, doing a renovation, not to flip, not to sell, but to get more rent, to get a wider range of tenants, to get depreciation allowances, to get the sort of property that's in strong demand, is another way of manufacturing capital growth and rents. Now, in the early 90s, during the recession we had to have, I learned that residential investment's a game of finance with some houses thrown in the middle. Because at that stage, well, actually, I'd had a lot of commercial properties as well, and the values of properties went down considerably, particularly commercial properties during the time of the financial crisis and the recession of the early 90s. And I didn't understand the concept of financial buffers. And I remember at the time the bank said, sell up. And I said, who to? No one was buying commercial properties. But over time, I learned about finance and how important it is. And that's one of the things that we put together when we do a strategic plan for our clients at Metropole. The first thing starts off with a financial plan. And the finance plan has nothing to do with the lowest interest rates, but it's actually making sure that you're buying yourself time. In other words, not just buying property, but time to ride the ups and downs. Taking on debt isn't a problem. Not being able to repay the debt's a problem, meaning cash flow management's a critical part of wealth creation. And again, as you probably heard me say over the years, we help build clients' strategic property plans at Metropole, even before we start talking about property, and finance is an important part of that. It also, I guess it's important to understand that there are 3 types of debt. Bad debt, borrowing against depreciating assets like cars or electronic goods or things like that. Necessary debt. So I guess you should avoid bad debt and credit card debt. Necessary debt, the second type of debt, that's non-tax deductible debt against your home. That's necessary. And then there's also good debt against appreciating assets like income-producing residential real estate. So I learned a lot about finance along the way, and the rules have changed so much. So the world of finance has changed a lot. So even some of the strategies I initially did, like living off your equity, has had to change because of the world of finance. But that's, again, part of the reasons why we regularly review the strategic plans we put together for clients. But as I said, residential real estate's a game of finance. And this, obviously, real estate in the middle of it. Now, another lesson I learned, it took a little while, was successful investors have a long-term strategy to grow their wealth, and they use the correct asset protection and finance structures as well as insurance to mitigate their risks. I didn't have a strategy. I didn't have a plan when I first started. I just knew I wanted to be rich. I knew I wanted to own real estate because I saw my friends' parents. My parents didn't have much at all, but I saw my friends' parents wealthy through real estate. I saw my parents' friends, I guess were my friends' parents, grow wealthy through real estate as well. So I didn't have a plan. My plan was to get rich. That's not a plan. My strategy was to buy property. That's not a strategy. My research was searching for a property. That's not research. So I learned over time the importance that strategic investors have a plan, a long-term plan to grow their wealth, and they use the correct protection. And actually, I did very early in the piece start using family trusts. I had a good accountant who taught me that very early in the piece, and I definitely used insurance over the years to mitigate my risk. And I learned that strategic investors not only buy properties, but they buy themselves time to ride out the cycle, as I said, by having cash flow buffers in facilities like offset accounts. I guess along the way, I also learned, I guess this was 20, 30 years ago, I first heard this strategy from Warren Buffett. He said, wealth is the transfer of money from the impatient to the patient. Now, like most young people, I was impatient. I was in too much of a hurry to get along. And over the time I learned, I said more I made more by saying no to perceived opportunities than yes to them. But that's a lesson I'd like to remind you. Wealth is the transfer of money from the impatient to the patient. Now, I'm working my way through, it's about 40 lessons I learned in the last 40 years. I hope you're getting some benefit from these as well. And you may have heard me say some of these things in the past, and for you, some of these will be new, some will be some repetition, and some will be, hey, how am I using this? And one of the lessons that's really important, become much more critical over the last years, since we've got social media and 24/7 news and the media available on our phones and our iPads, is that it's not the media's job to educate you. It's their job to get clicks on their links so that they receive revenue from the advertisers. So don't rely on the media for investment strategy or advice. I mean, if you think about it, how hard would it be to continuously come up with new stories at least once a day and fill out the media 24/7? So on that basis, you really, really have to remember that be careful who you listen to. Don't rely on the media for advice or strategies. Oh, by the way, you'll always find somebody out there in the media or on social media telling you not to invest. There's always going to be people telling you not to invest in property. So be careful. Why? What have they done? What have they achieved? And I think it's also really important when you get messages on social media or wherever in your inbox to understand people's vested interests. They don't usually have your best interests at mind. On the other hand, savvy investors surround themselves with a great team and they're prepared to pay for their advisors. They see it as an investment, not a cost. Pay for your mentors. Join mastermind groups. Come along to Wealth Retreat in April. That's really interesting because we have a group of, it's a closed session because we can't fit, we on purpose keep the room size small, and there's 95 people or so there, and they're already very successful investors, and there's many beginning investors or a small group of beginning investors as well. And an outsider would look and say, what nasty, greedy people. They're already well off, and what are they doing? They're wanting to go further. But there's a common trait amongst these people. They do want to go further. It's not just for the money. It's for their family, for contribution, to grow, to learn. Savvy investors surround themselves with the right people and have the right mastermind group and networks. By the way, if you're the smartest person in your team, you're in trouble. So why not consider joining us at Wealth Retreat on the Gold Coast, wealthretreat.com.au. Find out about it and spend 5 days immersing yourself in yourself, getting away from it all and learning the secrets. Now, I don't use that word lightly, of the other people there who are already probably even more successful than you. The idea really is you're not just going to learn from the faculty, but from people you have breakfast, lunch and dinner with over those 5 days. Go to wealthretreat.com.au, express your interest. You can't book in, but I'd love to have a chat with you. See, I talk to everyone who's going to join us at Wealth Retreat to make sure that it's suitable for you. And if it is, I'll give you my personal guarantee. Put me to the test. Now, another lesson I learned is you're going to make investment mistakes along the way. And you're either going to end up paying a significant learning fee to the market, or you can pay your advisors and learn from their experience, and it'll mitigate your risks. I mean, we know the story that 50% of people who get into property investment sell up in the first 5 years. We also know that of those who stay in the market, 92% never get past their first or second property. So I guess the word I was using a moment ago is they're paying a learning fee to the market because they've not bought the right property. Interestingly, I'm sure, if you're a regular listener to the podcast, you've heard me say that the property you eventually buy should be the physical manifestation of a whole lot of decisions you make and make in the right order. So property investment's a process, not an event, and it eventually ends up buying a property. But what you've really got to understand is that if you don't put the right strategy in place, you're going to make mistakes. So minimize that. Rather than paying a learning fee to the market, pay it to your advisors. But another lesson I learned, word of warning, no one really knows what's going to happen to the property markets. Look at all the false or incorrect, let's call them, predictions that were made, forecasts that were made over the last couple of years. Of course, there's 25 million property experts in Australia, aren't they? 26 now, I guess. Everyone seems to have an opinion on property. But you know what they say about opinions? They're like belly buttons. Everyone's got one, but they're basically useless. So my lesson to you is be careful who you listen to. Now, sure, it's important to have mentors, but make sure you're listening to somebody who's not only built their own substantial property portfolio, but somebody who's kept their wealth through a number of cycles. And that's, again, why let me give a shameless plug for Wealth Retreat, where you're going to spend 5 days with Simon Kirstenmacher and Dr. Andrew Wilson, Pete Wargen, Ken Race, a whole group of Stuart Williams is going to be doing a session on finance. There's going to be a whole group of people and the others who are there, the other delegates, who already have achieved what in many ways you want to achieve. So speak to somebody who's not only built their own substantial property portfolio, but somebody who's kept their wealth for a number of cycles. The thing is, over the last couple of years during the booms, it was really easy to make money. Let's see where those people are in a couple of years' time. There are just too many enthusiastic amateurs out there offering investment advice. At the end of each year, Brett Warren and I sit down and pull out the old Australian Property Investor magazines and your investment property magazines, you know, the old hard copy ones, and we see the pictures and the ads and the stories about people, and we play a little game. Where are they now? So be careful who you listen to, and don't listen to who most other property investors listen to for investment advice. Now, don't listen to accountants. They're good at doing tax, but they're probably not the right people to ask for property advice. Mortgage brokers can help you get a loan, and financial planners are good at minimising your risks, but none of these are well positioned to give you property investment advice. As I said, if you want to get to the next level, you can't listen to who everyone else is listening to. You really can't do what everyone else is doing. You're going to end up with the same results as them. Now, another lesson I learned along the way was that timing the property market's too hard. Now, I first learned Warren Buffett's concept of counter-cyclical investing in the 80s, and the idea was be fearful when others are greedy and be greedy when others are fearful. And I thought, hey, that's the way to do it, to try and time the market. But over the years, I found out it's just too hard. It's much better to buy the best asset you can afford and hold it for the long term. Now, an interesting thing I learned over time was, apart from the timing the market doesn't work, is that successful investors know how to create wealth at any point in the cycle. Have you noticed that? How some investors seem to do well in good times and even do better in bad times. And timing of the market really isn't important to them. On the other hand, there's others who do poorly in good times and even worse in bad times. Clearly, the market timing doesn't have much effect on them either. Now, that's interesting, isn't it? So don't try and time the market is the lesson I want to share with you. Another lesson I want to share with you is that not all properties make good investments. Of course, any property can be an investment property. You just kick out the owner, put a tenant in, and it becomes an investment property. But in my mind, less than 4% of the properties currently on the market are what I'd call investment grade. In other words, properties that are going to deliver wealth-producing rates of return. Now, I've written a lot about investment-grade properties. You'll read it on Property Update, or you see it in some of my other blogs, or you've heard it on the podcast. But what you've got to do is find a property that's investment-grade that'll outperform. Now, when I first started investing, there was no good data available. Once a year, the Valuer General in Victoria would bring out some property statistics, and they were so far behind it didn't matter. In fact, estate agents had the best data for local areas. They knew what sold and what didn't sell, but they didn't know all of Melbourne or all of Australia. And then over time, more and more data became available, and now there's a whole heap of people telling you, I'm going to help you invest, and I'm going to use AI, and I'm going to tell you through data where the best place to invest is, or what the best type of property to invest is, or when the best time to invest is. But data can be misleading, and it can be twisted to say almost anything. And the problem is property investment's part science and part art. Yes, you need to understand and interpret the data, that's the science, but you also need the on-the-ground perspective to employ the data, and that's what I call art. Let me explain. There's lots of people out there saying, oh, look, we've got all the data, so we're a buyer's agent, we can help you, and what we'll do is we'll go and we'll choose the right property. And by the way, we don't even need to see it. Now, that's actually interesting. A couple of weeks ago, I was speaking to somebody who worked with one of the very large buyers agencies, and they, while they're based in a particular state, were buying properties in other states. They didn't travel. They didn't go there. What they did was they'd get the local, he actually said it to me, the local selling agent, they'll take a video for me. I trust them because the video, I see that they're there, it's live, it's exactly what I can see. Others get spotters to go out and look for things, local property managers. That doesn't give you the perspective. A property manager doesn't know what makes a good investment. They know what's good property to let. By the way, a selling agent's the wrong person to ask. Hey, tell me about the property. So, property investments, part art, part science. Be careful whose advice you get, and don't work on data alone. In fact, it's very misleading. Over the years, I also learned that there are 4 ways you can make money out of property: capital growth, rental income, tax benefits, and forced appreciation or manufactured capital growth through renovations or property development like I spoke about. But I also learned that these streams are not equal. So while some people will say, oh, look, I'll get more cash flow so I don't need as much capital growth, they're not equal. Tax-free capital growth is the most important. Sure, cash flow is important to keep you in the property game, but capital growth will get you out of the rat race. You're never going to get rich from earned income or from savings. You're never going to get rich from rental alone, which you've got to pay tax on. You need your money to be working for you, even when you're asleep. So sure, invest in income-earning residential real estate, but use the power of leverage, compounding and time to grow your wealth, to build a big enough asset base that eventually you get your cash machine. So you've got to go through the various stages of investing, starting off with educating yourself, then buying high-growth or saving some money and getting a deposit and buying high-growth properties. And once you've got a big asset base, then you slowly lower your loan-to-value ratio to eventually live off the cash. That's one of the reasons why location is going to do 80% of the heavy lifting of your property's performance, because it's going to be what creates the capital growth. In other words, some locations will always outperform. Now, I know there are some people who are going to tell you, no, you can buy wherever, all properties go up in value, but the studies, the statistics show they don't. I mean, if you think about it, more and more of us want to live in the gentrifying suburbs, the better suburbs, the better amenities. And you can't tell me that the outer suburbs will ever be as valuable as the near beachside or gentrifying suburbs in the middle ring suburbs. Location will do 80% of the heavy lifting of your capital growth of your property, an important lesson to learn. Now, I spoke a bit about timing a while ago, the concept of Warren Buffett saying be greedy when others are fearful and be fearful when others are greedy. But the lesson I learned is don't follow the crowd, because the crowd is either wrong or usually late to the party. I already said, don't do what most property investors do. The majority of them fail. They sell up within the first 5 years or don't get past their first or second property. So I learned along the way that you've really got to treat your property investments like a business. There's no room for fun. Now, when I first started helping investors, I realised how much fun they were having. They were enjoying the search, the hunt, the property inspections, the negotiation, the fun. And I used to tell them, you're not allowed to have fun. Property investment should be boring so the rest of your life's exciting. If you want excitement, go bungee jumping, go trail bike riding, but there's no room for emotion. So treat your property investments like a business, track your cash flow, regularly review your property's performance, make your decisions based on evidence, on facts. Now, reviewing your property portfolio annually is an important part as well. Is it working? Is the portfolio working like you want it to? Is it going to get you to where you want to get to? The problem is, it's really hard to do yourself because there's usually a lot of emotion tied up in having bought it, time, money, effort spent doing it. So do it with an independent advisor like the team at Metropole. Now, what about diversification? That's something that I learned a couple of lessons from along the way, because I own a diversified portfolio. I've got residential, commercial, industrial, retail, offices, and I've got properties in a number of states. I've got apartments, villa units, a lot of townhouses and a few houses. But it's something you can't do quickly. Diversification takes time. So interestingly, I only invest in, I've got a real handful of municipalities my investments are in. I'm not going to go invest in another suburb that won't perform as well just because I got 5 properties in a particular suburb that does perform well. So diversification is for people who don't know how to invest. You'll never become an expert doing 100 things once. However, you can master things by doing one thing 100 times. So, yes, in time, you should diversify and diversify in different states so that, one year Sydney's market's going to do well and you go to the bank and say, look, Mr. Bank Manager, don't worry about my Melbourne properties. My Sydney properties are doing well this year. Next year, you refinance the Brisbane properties. But it takes time to do that. First of all, master one thing. Now, another thing I learned along the way is the importance of mindset in the success of property investment. I hope you're getting some benefit from these lessons. This is going to be a longer session than normal, but I hope a great session for you. Because, as I said, over the years I learned that it's not the data and it's not the property. What makes some investors more successful than others isn't their income, but having the right mindset. You see, the outside world is a reflection of your inside world, because your thoughts lead to your feelings lead to your actions, and your actions lead to your results. So while knowledge is important, successful investors take action. They don't fall into the trap of analysis paralysis. They know there's always going to be risks when they make investment decisions. There's always risks associated with investing, but they're not scared of failing because they know the biggest risk is actually not doing anything to protect your financial future. So that's why I always have a mindset message as part of my podcasts, because, as I said, I think one of the biggest differences, not one of the biggest difference between successful investors and average is their mindset. Now, they also understand, successful investors, that they do fail, because sometimes negative experiences, mistakes and failures can be even better than success, because they teach you something new, maybe something that another win would never have taught you. How often we're so often driven to get things right that we fail to see the value in things that we get wrong. Instead, we spend our time wishing we'd done things differently, or maybe not doing anything at all because of the fear of making a mistake. The analysis paralysis. Look at all those people who sat on the fence a year ago worrying that the property market was going to have a challenging time, and now 12 months later, many properties in Australia have had double-digit growth and they feel they've missed out. So rather than being scared of making mistakes, if you get it wrong, learn from your mistake and make it count by doing things differently next time. One failure can, with time, help you create many successes. And don't waste your time worrying. Most of the things you fear about will never happen. They're just monsters in your mind. And if they do happen, most likely the things that are going to happen aren't as bad as expected. Remember all those cliffs, the fiscal cliff, the high interest rate, the fixed interest rate cliff, the unemployment cliff? They didn't happen. So have a think about it. Time spent worrying is time you could be spent identifying opportunities and taking action. Now, along the way, though, things will go wrong. Never give up. You're going to have failures along the way. In fact, I'm a real success at failure. You've probably heard me say that in previous episodes of the Michael Yardney podcast. But each time I've been knocked down, I get up again. You need resilience to be successful. So there you have it. I think there were 40 lessons there I learned over the last 4 decades. But since I've been investing for, over 50 years now, I've learned even more lessons along the way, and I'm going to keep sharing them with you on the Michael Yardney podcast. But let me leave you with a final one. Always continue learning, because the markets will humble you if you don't check your ego at the door. Thanks for taking the time to listen to my investment lessons. I hope you get some benefit from them. I hope you got some benefit from my reminiscence and my lessons. And if you did, but you don't currently subscribe to this podcast, just stop before we do the next couple of sections and just register so that you get the regular downloads of the information my guests and I share with you. By the way, I've also got a bonus way of saying thank you. Go to podcastbonus.com.au and you can download a heap of ebooks and reports. Again, my gift, my way of saying thank you. But since you subscribe to this podcast, since you listen to my commentary, I presume you're already successful at what you want to do, but you're driven to move to the next level. You're driven to keep your income growing. You're driven to build an impressive asset base that's eventually going to give you the family, you and your family, the lifestyle choices that you're looking for, the financial freedom you're looking for. Hey, does that sound like you? And I assume you'd relish the opportunity to meet and be influenced by a high level of like-minded high achievers such as you. And I guess you're also keen to learn and get a large pool of breakthrough income-boosting property, entrepreneurial, finance and business strategies. I've got that available for you at Wealth Retreat. We're going to be holding Wealth Retreat on the Gold Coast at the end of April, and I've put together the best faculty of property, economic and business people I could, finance experts, so that you can take advantage of the current property cycle. So go to wealthretreat.com.au, find out all about it, look at our expert faculty, and put me to the test, because I speak to everybody who's keen to join to make sure it works for you. And if you do join, if you're prepared to come, I'll back you with my money-back guarantee. Put me to the test. Go to wealthretreat.com.au and don't count yourself out, even if you're not at the level you want to be yet. Maybe this is your opportunity to get there.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
I've got a short mindset message for you today, but don't let its brevity fool you, because I want to explain to you that you should expect failure, because when you do, fear loses its power over you. I found that one of the biggest things holding people back from their pursuit of success in all areas of their life is that they fear failure. This fear of failure causes them to second guess every move they make. It causes them to overthink everything. It causes them to delay action. And we know that overthinking and procrastination is born out of this fear of failure. On the other hand, those who succeed in life, they don't think they're going to fail. They know it. They know their journey to success will be riddled with failures and mistakes. In short, they expect to fail. And when you expect to fail, fear loses all its power over you. When you no longer fear failure, you feel empowered to take action. You'll screw up, you'll make mistakes, you'll fail often. I've often said I'm a real success at failure, but you'll learn from your mistakes and your failures, and as you learn, you'll grow and you'll improve. And this growth will cause you to gain confidence, and this confidence will empower you to take even more action. I remember reading Dale Carnegie saying, inaction breeds doubt and fear. Action breeds confidence and courage. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?